All right, folks. I know I put that out there a couple minutes ago that we were going to have a discussion on leverage. That this is based off of a specific question I got on an email. And so, if you're not going to be around all day, that's a good way to get a question that you have answered, and you don't necessarily have to be around for it because I'm recording it. Okay, so the answer or the question was, essentially, it was a real life example of somebody yesterday bought some calls on the close, and with the market movement today, did very well with it, and wanted to know if this was, if is this a better way to do things? And my short answer was, well, it's impossible to say. If you tell me where we are now and where we're going to be in a certain amount of time, I can tell you what would have been the best way to do that. But the thing is we didn't know. I didn't know that the Qs were going to be up 1.8% today. I don't think anybody else did either. I mean, somebody could have guessed that, like we said, but you don't know. I mean, we could have gone up and then back down. We could have sat here. We could have gone up way higher than that. So how do you know? And the answer is you don't. And so how are we best able to, over time, because if you just buy a call, and that I think that's, and I'm talking obviously not for day trading. I'm talking about if you're planning on holding this at least overnight, if not for the foreseeable, at least short-term future, like we do with our directional plays. So what is the best way to do that? So if somebody wants to throw out just a stock, it doesn't matter. We're just going to go through the example of what would be better. So, buying the stock, buying the call, buying a vertical spread. Now, of course, there's all kinds of combinations of things that we can do, but let's keep it, relatively simple. All right, and well, let's not do. I mean, we can do Amazon, but you're talking about bigger numbers here. I guess it doesn't matter. Amazon, fine. Oh, we'll stick with Amazon. It's all right. Okay, so we don't really visit this tab on the trading tool very often, but it's the last tab, and it's called the leverage calculator. And it, I think we've talked about this before. I went and looked in our video archive, and I didn't find anything that was specific to. I thought I recorded it. I guess I didn't. But at any rate, we haven't talked about it in a while. So for those that are new, this might be something a little bit new, and for those that have been here for a while, maybe it's a review. Okay, so let's just say, okay, we have Amazon, we have it up here, and let's go with a generic go out to regular September options, just being arbitrary here. Okay, so and here we are with the 1 billion. Man, I'm gonna cut these down a little bit if I can. There we go. I want to do at the money plus or minus, whatever, 15 or 16. I don't need to see 100 of these things. Okay, so going out to regular SEP. Here we are at the money. We're trading 18.29.5 or so. So let's put that in here as our price, 18.29.5. And this is this piece that I'm taking out here is something that I just pulled from the distribution calculator, the standard deviation calculator. So if we're going to go out to regular SEP, which is the 20th, right? September 20th is regular SEP, so 920. And the vol for that is at 27.5. So our reasonable move is for a standard deviation move, it's about 10%, and for a 59% confidence interval, it is about 8.35%. Just so we have an idea of what we should do. Okay, and so let's say no matter what we do here, we're going to. So let's just say generically, let's target the 19. Let's just target for nice round numbers. Let's target the 2,000 to the upside. Okay, so We think that we're going to get almost a full standard deviation, and we're going to be trading at 2,000. Okay, so we have $25,000 in our account, not arbitrarily, but in this example, and we're going to allocate 3%. Eloise, everybody should be hearing me fine. Everyone have audio? It looks... Okay, Jake, I'll see you later. Can I just get a yes from you guys that you do hear me? Okay, cool. Okay, so let's just say that generically we're looking at a 3% allocation on our $25,000 account. That means that we want to invest $750. That was kind of the reason that I did, but we can, I mean, since we're using theoretical examples, but that was kind of the reason I didn't want to use an $1,800 stock, but it doesn't really matter. Okay, so we're trading 18, so that means that basically I can buy 0.41 of a share of Amazon if I'm just going to buy the stock. Everybody see how that is? All that is 750 divided by 1829.5. So I can buy 0.41, and let's just say that we said that we are going to target $2,000. So if we did that, we have 0.41, and I know that we can't trade 0.41 of a share of stock, but theoretically we can, and using the math we can. That means that we are going to make $69.90 for a return on our $750 profit or investment of 9.32%. Everybody catch that? Any questions on how we got that? This is just straight buying the stock. And we're targeting that $2,000 mark just for nice round numbers, and it happens to be very close to a standard deviation move. All right, so I'm not seeing any questions. Okay, so now let's say that somebody says, okay, well, you know, Mike, I'm going to buy an at-the-money option today. So we said that we're looking at about 1830. The 1830 calls cost $66.55 theoretically. $66.55. So that means I can buy, because each one of these is $6,000. $6,655. That's what happens when you're dealing with a stock like this. So that means I can invest 0.11 of I can buy 0.11 of an at the money call option. We know that we can't do that, but for our theoretical we can. So the strike price was, that's the 1830s, right? 1830s. And so that option is going to settle if we go to 2,000 at $103.45, which is simply the 2,000 minus a strike price minus the purchase price of the stock. So the option settlement is going to go to 103.45. Because we got 2,000 minus 1830, which is 170. 170 minus 66.55 gives us 103.45. So if we had 0.11 of these, and we still want to risk $750, well, now we are going to make, the profit is going to be the option settlement, which we figured out was 103.45, how many we had times 100. So we're going to make $1,165.85 for a return on our risk of about 155%. And like I said, this is in the regular trading tool. So if you want to play around with it, it's here. I'm giving you just a real life example. But let's say, okay, now let's say that we don't want to spend over $6,500 to invest in an at the money, and we don't want it. And remember, this is giving us control of 100 shares of stock. If we want to do 100 shares of Amazon, that is $18,295. Is that right? No, it's $182,295. $950 that you're going to have to either come up with that money, or you're going to have marginal securities on that. Yep. See why I didn't want to use a $2,000 stock, Robin? My diminishing math skills are getting outed here. Okay, but let's what if we buy a vertical spread? So let's say that we're still targeting this 2,000. I need to put some more in here. Let's get 20 in here. Nope, there's no problem at all. That's why we have the spreadsheets do the math for us. Okay, so still targeting this two. Why did it? Hang on, because there's smaller strikes in here. We should get the 2,000s up here. It's not. I need. Let's see if that works. Is it? That $5 wide strikes going out to Sep 20. Okay. Oh, you know what the problem is here is I don't think they have them listed that high yet. At the money. They only let us go that high. So I don't think they have them listed out to 2,000 yet. Maybe they do. We'll do that. But it looks like the 1930s might be the highest ones. Eloise, it's Mike. We're talking about option leverage. Okay, well, okay, we're going to have to, let's start over here and go to Caterpillar because of the size of the underlying, we're going to have to go. All right, we need something a little bit smaller, something on 120, no problem. All right, same thing though. Okay, we're looking at 121.89 going out to regular SEP, and that's 27.1 vol. All right, so we're looking at a move of approximately, high 8s, low 9s, given a standard deviation move, and let's target the 133 strike. Just in general, 133 is where we think that we're going to go. And we can't do that. Let's target 130, because we have $5 wide strikes here. Let's target 130. That's not the biggest move in the world, but let's see what happens. Okay, so we got that. We know that the price of the stock is 121.89, and we think that we are going to go to 130. Well, that means that we can buy 6 shares of stock, 6.15 actually. So we're going to make $49.90, which is about a return on risk of about 6.65%. Not too bad for what, 43 days? Okay, if we buy an at-the-money call option, the at-the-money call option for SEP is the one closest to, it's right between it's a little bit higher, or a little bit higher than 120 and far off. So let's just say that we can buy, if there were an at-the-money option, which there's not, it's only the 120s. No, you're gonna have to buy an in-the-money option here. So that means we're gonna have to buy the 120s. It's not that much in the money. So the cost of the 120s is 578. So we can buy 1.3 of these for our $750 investment. The strike price we said was the 120 strike, and so that means that our option settlement, which is our target price 130 minus 120 minus the price of our option, is $4.22. We own 1.3 of these, and so we make $547.58 for a nice return of $73.01. So clearly, you're better off buying a call option than stock, but there's always a give and take. The give and take here is that The stock you theoretically own forever, even if it goes to zero. Doesn't matter, there is no time expiration on it. There is a time expiration. We said that we're going out to September options. Okay, so let's do, and so if we are, and let's do the same thing, we'll do the 120, 130 call spread here. So if we do the 120, 130 call spread here, buy the 120s, still buying that same in the money option, but saying, hey, anything that we purchase premium-wise over 130, or certainly 135, is kind of wasted premium from a statistical standpoint. The price on this thing is $4.29. So $4.29 for a one lot. So we can buy 1.75 of these. And we did the 120, 130 call spread. So we're going to make $10 on that because we went to 130. So now we can see, and this is even with the strikes aren't being not lined up very well, right? We're buying them over $1 in the money option, and we're targeting less because of just how the strikes happen to be. But we can look here that, okay, that means that we make $10 on our spread. Of course, we paid $4.29 to get into this thing, so we can only buy 1.75 of those. Same capital at risk. Here we make $998.25 for a return of $133.10. Now, that isn't as stark of a difference, but that's because the strikes didn't line up, and that's just the two examples that we were given. And that's why sometimes we like a technical setup for a directional play, and we end up not doing anything because of a number of things. One, the open interest isn't good, the bid-ask is too wide, or the strikes don't statistically add up for us to target the right thing. I mean, ideally, I would want to do something like I would love if we could target 132, but even doing the 125, 130, still targeting that same thing, that is trading for significantly less. That's trading for $1.65. Well, we can buy a heck of a lot more of those, right? We can buy, instead of 1.3 calls, we can buy 4.55 spreads. And that's still, this is 125, so now we make $5 on our spread. We had to pay $1.65 to get in, so that's $3.35 times our position size here. Well, now we make $1,522.73 for a return on our investment of 203%, just very, very slightly over that. So this is where the leverage comes in. Now, again, if we buy a slightly in the money option like we did here, well then that's fine. But if we buy slightly in the money option here and we don't get up to the 125 strike, we're at least going to be able to recoup some of our. Robin asked if this is in my folders. Are you talking about the spreadsheet? Yeah, it's the trading tool. It's just the last tab on the trading tool. And we can look at it like this too. Instead of buying the slightly in the money call, we can buy this slightly out of the money call, the 125s. Those only cost $3.13. Still targeting. This is for the 125s. Still a nice return, but for the same amount of money and targeting the same thing, we're getting on the orders of just slightly 4 to 1, or 4 times as big. Okay, there are numerous videos out there that explain the trading tool. This is just a specific one about the leverage calculator tab inside of that, but it's sitting there. It's called, you can see at the top of here, Prosper Trading Options Trading Tool. And the last time I saved this as something different was back in April, but I'm always making little tweaks to it. I just probably didn't change the date, but it hasn't changed. So this is showing the leverage. Now, of course, this is with the benefit of hindsight. We maxed out this spread. We got there by SEP in both of these times. If we didn't get there by September, we would still own the stock. We could put that in our, we could put that in our grandkids' account, and they'll still have it. But this is, this is kind of like a best case scenario, and that's all we can do is go by what statistically is relevant and what is feasible, because we trade in the realm of probabilities, not possibilities. It's possible that CAT goes to 0. It's possible that it goes to 10,000. I don't think either one of those are going to happen anytime soon. Vertical spread and a bull spread are the same. Bull call spread are the same things. Exactly the same thing. It's just different. You'll hear Scott and I will call these either. We'll call it call spread mostly, or sometimes a vertical, but certainly in this room, we concentrate on vertical spreads or combinations of vertical spreads, like a broken wing fly. So that's just an example. The strikes didn't line up perfectly, but the theory behind it works out. But again, there's always a give and take. But we're trading here. We're not investing. If you're investing, well, that means that your time horizon is not 2 months and within. You're probably better off buying stock. Okay, any questions on this? Let me know. If not, I recorded this and you can review it, and if it doesn't make sense to you tomorrow, we can go over it again. Okay, the markets have come off maybe 10 or 15 basis points since we started this. It's not surprising that there's a little bit of profit taking. Let's see, the close should be interesting. We still got an hour and 10 minutes until that happens. Okay, I'm going to stop the recorder, and let me get this rendered out to you so you can review it tonight if you like. Thank you for the question via email, and you guys all feel free. You can always do that. I'm Shorr Prosper Trading. You can always email me, and I will do my very, very best to get back to you as soon as I can. All right, thanks a lot, and let me get this set up to you, and we'll just move on, and hopefully we find something to trade in the last hour of the day.